What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome back to another episode of the CPA Zone. I'm your host, Ryan Pulis, and today we're talking about something that came out of the One Big Beautiful Bill Act in 2025, and that's qualified production property, or QPP. So QPP is a tax rule that could potentially let you write off certain production-related buildings immediately. So that's the whole building, rather than depreciating it over 39 years. So if you're a business owner building or expanding a manufacturing facility, let's say, or a real estate investor who actually operates a production business inside a facility that you own, this could be a huge tax benefit. So quick disclaimer, this is education, not official tax advice. The tax rules depend on your facts, and the IRS doesn't really care if you feel like it should count. You actually have to make sure all of your facts line up and you qualify. So let's get into it. Generally, if you buy non-residential real estate, like a commercial building, you're depreciating that over 39 years. But qualified production property is different. Under new rules, you can potentially claim 100% depreciation deduction on the QPP portion in the years placed in service. That's if you elect it. So that can really change your cash flow situation pretty quickly. So, however, before you start mentally spending your refund, there's a lot of rules around this. So let's just walk through some of those. Now, QPP is not a whole building automatically. So the law is a lot more specific. It's the portion of non-residential real estate that's used by the taxpayer as an integral part of a qualified production activity. It has to be located in the United States. It has to meet certain timing rules and original use rules, and there has to be a proper election in place. So a key phrase here is portion. You might have a facility where 80% is a production floor and 20% is offices and admin. That production portion might qualify. That's the 80%. The office portion, admin area, generally not going to qualify, which leads us to the next question. What actually counts as a qualified production activity? Now, the IRS describes a qualified production activity as manufacturing, production, or refining of a qualified product. And a qualified product is basically going to be some type of tangible personal property. Stuff you can touch. That there's an exception for food or beverages prepared in the same building as a retail establishment where that food or drink is sold. But generally, you're talking tangible property that has some type of substantial transformation. So that means you're taking inputs like raw materials and components and turning them into a final product that's fundamentally different. Now, the IRS gives a few examples. They talk about converting wood pulp into paper or steel rods into screws. So you get kind of transforming the product. What doesn't count are things like just packaging or bundling finished goods. So like gift baskets or subscription boxes, though that's not substantial transformation. So if your production facility is really just, hey, we received the finished product and put it into better packaging, you're probably not going to qualify. You actually need to make stuff there. Now, even if you're doing real production, QPP only applies to the portion of the building that's used as an integral part of that activity, that production activity. So the law specifically excludes a bunch of stuff. So it does not include things like offices, administrative services, lodging, parking, sales activities, areas for research activities, or software development and engineering activities, and pretty much any other function unrelated to manufacturing, production, or refining. So you can have a production facility with a front office or a conference area, sales area, etc., but all those things really get carved out as non-QPP. So another sneaky one is finished goods storage. So certain storage, especially storing finished products, can be treated as ineligible. Now, storage of raw materials and work in process can usually be treated as part of the production if it's essential and tied to the production process, but that finished goods generally not going to count. Now, for real estate investors, this isn't what you want to hear, but it just is what it is. If you own a building and lease it to a manufacturer, do you get the QPP? And generally the answer to that's no. It's not just because your tenant is in manufacturing. So because of this rule, if you're the lessor, property used by the lessee isn't treated as used by you as an integral part of production. So a triple net landlord with a manufacturing tenant usually doesn't get to claim this QPP deduction. But if you're an owner operator, meaning your business is running production activities in a facility that you own, then you're in the game. So this is one of those tax follows the activity type concepts. The IRS wants the deduction tied to the taxpayer actually doing the production. Now, there's also some timing rules. So from the IRS guidance, construction has to begin after January 19th, 2025 and before January 1st, 2029. And the property must be placed in service after July 4th, 2025 and before January 1st, 2031. So there's also rules on how you determine when construction begins. They reference concepts consistent with bonus depreciation, construction rules, and safe harbors. There's also an automatic 1-year extension of the placed in service deadline in certain disaster area scenarios. So basically, if you're planning a big build, the timeline, the documentation, that stuff's going to matter a lot. Now, generally, original use of the property has to begin with the taxpayer to qualify as QPP. So it's aimed heavily at new construction and first use situations. There's also a special rule for certain used property where the original use and construction begin requirements can be treated as met if the property was not used in a qualified production activity during a specific time period. The IRS, they love their calendars. So this is one of those areas where you really want to get your CPA involved early because your facts, the property history, and documentation really are going to be key drivers here. Now, there is a de minimis rule here. So if a very high percentage of the building is production eligible, you can usually treat the entire property as satisfying the integral part requirement. So an IRS example uses a 95% threshold based on square footage, and it shows the taxpayer treating the whole building as qualifying when the non-production space is small enough, so that 5% or less. So if you've got a production facility with a tiny office and maybe a small non-qualifying area, you may not have to carve out the QPP and non-QPP areas. But if you've got like 30% offices and admin, then yeah, you're going to have to do the allocations. There's no getting around it. Now, this deduction's elective, and the election has to be done correctly. So generally, a taxpayer makes the election by attaching a statement to a timely filed original tax return, including extensions for the year the property is placed in service. That includes descriptions of the properties, basis amounts, and how much basis you're designating as QPP, plus any special declarations like de minimis usage or disaster extensions. Now, there's some strategy that can come into play here. You might be able to designate less than the entire eligible basis as QPP. So basically, you don't have to go all in. Just because the whole building may qualify or a very large portion, you don't have to say or elect to treat all of it as QPP. Maybe you want to play with your deductions a bit. So sometimes you might get to choose a more manageable taxable income or limitations or other issues. So that kind of helps you do a little bit of planning around this. Now that brings us to the next planning tips and a few things to watch out for really. So one, recapture risk. So if QPP later stops being used in qualifying production, like you convert part of your facility into offices or some non-qualifying use, there's rules that trigger recapture with the disqualified portion treated under Section 1245, which is ordinary income recognized in the year of change. It's just like your traditional ordinary income from depreciation recapture. Also, another thing to watch out for is the state conformity. So many states don't automatically follow the depreciation rules that the IRS sets. You can get this huge federal deduction and not much at the state level, or there's an add back for what the state doesn't allow. So there's often different treatment at the state level. So just be aware of that and plan accordingly. Again, we already covered this piece, but it's worth repeating. When you lease to a manufacturer, that's not going to get you there as the landlord, unfortunately. Documentation, key, floor plans, your engineering drawings, process flow diagrams, your construction invoices. This is all important to keep on hand. They help support allocation between eligible and ineligible spaces. And the IRS guidance, they require you to use a reasonable allocation method when you can verifying that QPP versus non-QPP parts of the building. So a quick example of how this will work. Let's say you own a business that manufactures custom metal parts. You build a 50,000 square foot facility for $5 million. We're going to exclude land. say 40,000 of that is production floor, and that's going to be your qualified production area. Then 10,000 square feet of the 50 is for like offices, admin, sales. That's 80% of the building is production related. That means you can deduct up to $4 million, 80% of the $5 million building cost. It's QPP. So that's a massive year one write-off. Now, if you think QPP might matter for you, here's what you want to do. You want to identify the project early before construction is complete, because your timing matters here. Confirm you're the operator of the production activity, not just a landlord. Map out the building's use, get your floor plan, designate what areas are going to qualify versus what do not. Track your costs so your allocation is defensible, and coordinate with your CPA on the election, the amount to designate, and any limitations. So that about wraps up today's talk on qualified production property. So the big takeaways are it can allow 100% expensing of a qualifying portion of certain buildings for commercial real estate. The definition is a bit picky. The production use, integral parts, exclusions for office, admin, etc., storage nuances. So you got to make sure you do it right. And for real estate investors, unfortunately, being a landlord is not enough. And if you're going this route, the election and all the documentation are really key to everything. There's recapture if the use changes later, so be careful there as well. That about does it for this episode of the CPA Zone. If this was helpful, share it with a friend and hit that like and subscribe button. Until next time, have a great day. Are you interested in becoming a client? Click the discovery meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulicegroup.com/contact. That's ThePulicegroup.com/contact.